Everyone seems to be chasing the magic 10 properties when investing in property or when they're starting out investing. But what if I told you could make more money potentially with just 3 properties if you set it up in the right way? Hi, I'm James and welcome back to James Talks Property, where I'm focused on helping you become a more informed property investor without gimmicks or unrealistic promises. I'm the co-founder and managing director of a property investment business called Property Partners, but this channel is all about helping you grow your knowledge and understanding. Don't forget to hit like if you like the video and subscribe to the channel. So what is the problem with the numbers game when investing in property? The honest answer is too many people equate the number of properties that somebody owns with their true wealth. Obviously, there is some correlation. The more properties you own, the chances are you have more equity in your portfolio, but it's not a blanket rule and you shouldn't just be chasing a target number of properties of 10. This is because if you're doing this, the chances are you're probably going to be buying cheap properties just so you can buy more regularly so you can get to that magic number of 10. That doesn't mean that you're actually going to achieve what your goals are within property investment. This can often lead to you over leveraging, buying properties in poor areas that aren't going to grow in value moving forward, and even having a poor cash flow in your portfolio. For example, if you own 10 properties that are worth £100,000 and they're all leveraged up to the 75% loan to value, you might actually have a slightly worse portfolio than someone that only owns 3 that are worth £350,000 that are leveraged up to 65% loan to value. This is because they have more equity within their portfolio and they have more of an opportunity to do things with their portfolio and scale in the long term. So why should you be chasing equity over the number of properties? The first is equity is a more true reflection of the amount of wealth that you have within your property portfolio. If you don't actually know what equity is, it's just the amount of capital you have that is yours within your property portfolio. So it's the deposits that you've put into your property plus any growth in that value of the property while you've owned them. As your equity improves over time, it gives you more of an opportunity to scale a portfolio and reinvest your equity through a refinance. If you're in a position where you're actually able to save cash faster, you don't have to refinance as aggressively with your property portfolio, the equity in your portfolio will actually give you a bit more of a safety net if there is ever a downturn in the market. Funnily enough, equity is actually a more true reflection on what your portfolio might be able to cash flow for you in the long term. Essentially, this is how a lot of our clients at Property Partners look at getting their income in the long term. They potentially sell 1 or 2 of the properties that they own. They'll use that cash to pay off or reduce the debt they have on their portfolio, and at that point they can focus on the income in the portfolio. This is something that comes with time. It's not the main focus early on. The main focus early on is scaling the portfolio to a position, and then we can focus on the income further down the line. So for example, if you want to earn 5k a month from your property portfolio in the long term, we know we need to scale your portfolio to build your equity to about £1 million. And then once we've hit that, we can focus on your income further down the line. So let's look at 2 people that currently have property portfolios and compare and contrast the 2. So first we have Mike. Mike has a property portfolio of 10 properties. These properties in total are valued at £1 million and he's got £250,000 worth of equity in his portfolio. That's a loan to value of 75%. These properties will obviously vary a little bit in price, but they'll all be valued somewhere between £60,000 and £110,000. Tina, on the other hand, only has 4 properties. She also has a valuation of £1 million across the 4 properties. However, she has £330,000 worth of equity across the 4 properties, which is a 66% loan to value. This means that although Tina has significantly less properties than Mike, she actually has about 80k more of equity in her portfolio than Mike does, that she can do more things with. This means that if Tina chose to refinance one of the properties, recycle some of the equity and purchase another one, she'd have that opportunity. She could also keep the property with that amount of debt on and give her a bit more flexibility within her portfolio. Mike is still in a good position. He's got £250,000 still within his property portfolio in terms of equity, but he's going to have a few more headaches and a few more problems along the way. He's going to have more maintenance costs. More properties means more maintenance, and that means he's going to make slightly less money in the short term from those properties. He'll have a higher turnover. Again, because he's got 10 properties rather than the 4, you're going to have a higher turnover of people that are moving in and out of these properties that you will have to deal with, whether you have it managed or you self-manage yourself. Both these things mean it's going to be more time consuming for Mike to manage his property portfolio. Although he could have it managed, he's still going to have to take phone calls from the people managing the properties if they ever need to pay for anything or if he's getting new tenants. Mike has also paid for things like broker fees and legal costs 10 times while scaling the property portfolio. These are often fixed costs, which is a bit frustrating when you have to do that over and over again when scaling the property portfolio. And the final and probably the biggest problem with this is Mike's opportunity to scale his portfolio might actually be pretty limited because of the type of properties he's purchased and targeted. When you buy properties for £60,000 to £100,000, which are usually the lower end of the property market across the UK, you're buying properties that not lots of home buyers are wanting to purchase. This means that demand is low, which means there could be a limiting factor to capital appreciation over time. If people don't want to live in these properties or don't want to purchase these properties, demand drops. That means prices aren't going to increase as they would in other locations. So although Mike is in a good position and he has £250,000 in his property portfolio, he might want to start looking at the portfolio and upgrading the cheap and cheerful properties to things that are a little bit more quality and a little bit more likely to grow in value in the long term. Let's say Mike and Tina both have a goal of achieving £5,000 a month from their property portfolio. The easiest way for them to both do that is to scale their equity that they currently have to around the £1 million mark, assuming that they're getting in and around 6% net yields. Again, it's going to be easier for Tina to do that because she's bought good quality properties in great areas that are primed for long-term growth and have a high demand for both tenants and home buyers. It's not to say that Mike's wrong, but he's not quite done the right strategy for him based on his current situation and his goal. That is, unless Mike's able to save a lot of money in a very short space of time and just continue to buy these properties over and over and over again without having to refinance and scale the portfolio that way. Often, fewer, better quality properties in areas that are still primed for long-term growth will outperform cheap properties that yield better. Again, as we scale the portfolio and as we look to diversify further down the line, we might look for some slightly more affordable properties that yield well, like the properties that Mike has purchased. But when we're growing the portfolio, we need to focus on equity. We'll get there and then we can focus on the income. So to conclude, chase equity, not the number of properties in your portfolio. Focus on quality deals that are likely to grow in value and give you the opportunity to build this equity and scale your portfolio. Remember, this isn't a vanity project. It's an opportunity to scale our portfolio and really build long-term wealth for ourselves and our families in the future. But that is essentially it for this week's episode. So thanks again, and I'll see you in the next one.